Guys, so today we're going to talk about FHA loans. In this video, I'm going to walk you through exactly what an FHA loan is, what requirements you need to meet in order to get an FHA loan, and I'm going to give you some tips on how to determine whether an FHA loan is the right loan for you, because that's not always the case. So let's jump into it. What's up, guys? I'm Ben Sund. Welcome to my channel where we talk about improving our overall financial health through things like personal finance, investing in real estate. So in this video, as I said in the intro, we're going to talk about FHA loans. What is an FHA loan? So an FHA loan is one of the four major types of loans. There's conventional, which we'll talk about in a different video. There's FHA, which we'll talk about in this video. There's VA, which you can see one of my other videos up here somewhere. That's a veteran loan, so it doesn't really apply unless you're a veteran. And then there's rural development or USDA loans, which are for people that buy outside of bigger cities. They're sort of the rural, out of community or out of city loans. Again, I'll make a separate video on that. Generally speaking though, the two loan types that you're gonna run into are going to be FHA and conventional. So later on in this video, I'll do a comparison, just kind of giving you an overview of the differences between the two, because sometimes it's better to go FHA, sometimes it's better to have a conventional mortgage. This is something that you're going to talk to your lender about, or at least your lender is going to review. This video is just going to be sort of an additional tool in your toolbox to when you have that conversation with your lender, you're going to know the questions to ask, or you're going to know what to look for. Speaking of lenders, guys, I'm a lender, but I'm not your lender. And so it's important for you to find at least one lender that you trust, that you can talk to. I recommend at least 60 days prior to closing. The last thing that you want to do is find that dream home, maybe that home with the 3-stall garage, or that home with that finished basement bar that you've always been wanting. And then you get to the lender and you realize that for whatever reason you don't qualify, or you don't have enough money for closing yet. And that can completely blow up a deal. We'll talk about how much you need for closing in just a second, but I just wanted to say that it's so important that you find someone that you can trust, that you can talk to, and that can give you all the information that you need up front in order to make the best home purchasing decision that you can. FHA just refers to the guidelines that a bank or a lender uses to approve a borrower for a loan. We'll go over some of these guidelines because they are important for you to understand, but as a general rule, most of them you don't need to go that deep. It just means that it's a federally backed loan, and these are the guidelines that the lender uses. Whereas a conventional mortgage is not a federally backed loan, and the bank or lender will use a different set of guidelines. This is why sometimes it might be better to go FHA, sometimes it might be better to go conventional. They each have their own guidelines, and they each have their own little rate sheet. So sometimes it could be cheaper, or you'll get a better rate if you go conventional, and sometimes it'll be cheaper and you could get a better rate if you go FHA, just depending on some of the guidelines that we'll talk about in just a second. The first would be the down payment and the closing costs. So an FHA loan requires that you have at least 3.5% down. That's the minimum that you can have. The 3.5% down has to be of your own money, or of a gift from a relative or a family member. So on a $200,000 house, you'd have to come up with $7,000 down payment. Again, it can come from money that you have in the bank, it can come from your 401k, it can come from a gift, but it has to be of your own money, meaning that things like down payment assistance don't apply to the 3.5% down. We'll talk about that a little bit later more in detail, because it's still handy to have. But if you get an FHA loan, you're going to have your 3.5% down. Now, the 3.5% down might not be the only cost for your mortgage. There are things called closing costs and prepaid items, which are prepaid taxes and insurance. These are the fees for your lender and your title company or attorney to do the paperwork for your mortgage and make sure that you have a clear title and clear ownership of the home when you close. This protects you against having, say, the previous owner owed back taxes. It prevents you from closing on the mortgage and then getting hit with a tax bill. It makes sure that you have a clean set of title so that the seller had paid all the debts that they had to pay in order to sell the home. And then again, the prepaids are the taxes and insurance associated with the home. This is usually a prorated amount. meaning that if you buy in July, the seller takes care of 6 months of the taxes and you take care of the other 6 months, unless it's agreed upon. Again, this is getting a little bit too into the weeds. It's just prepaid taxes and insurance for when you close. These fees can vary quite a bit. I would expect anywhere between 2 and 6% of the purchase price. So on $200,000, you could expect up to $12,000, not including your 3.5% down, in additional costs. That means if you're not talking to your lender throughout the process, or your lender's not communicating with you throughout the process, you could get to the closing table and realize that you owe $19,000 and you might not have that money. Don't get discouraged. There's a few tips or a few things that you can look out for ahead of time to make sure that you're not getting surprised with a big bill that you can't pay. But a little bit later in the video, I have a few solutions for you that could save you thousands of dollars. And these are going to be questions that you should ask or things that you should look out for ahead of time so you know what to expect. Now, the other cost with an FHA mortgage is what's called upfront mortgage insurance. I didn't rope this in with the closing costs and the prepaids because this is a fee that's rolled into the mortgage, but it's still something that you're eventually going to have to pay, and it's 1.75% of the loan amount. Now, this can be one of the single biggest reasons why you wouldn't get an FHA loan, because it makes the loan more expensive than, say, a conventional loan that doesn't have upfront mortgage insurance. So on our $200,000 example, you're going to have $3,500 rolled into the mortgage. Again, this is paid off as you make monthly payments, but it's something that adds to the cost of the mortgage. So let's talk about FHA's credit requirements. These are going to be the main reasons why you would have to go FHA or why you'd want to go FHA rather than conventional. FHA carries a lower minimum credit score. So in order to put 3.5% down on an FHA loan, you're going to need at least a credit score of 580. And if you have under 580, you're going to have to put 10% down. Now, as a note, FHA will allow lenders to lend under 580, but most lenders do what's called an override or an overlay, and they set their own guideline and they won't lend under 580. A lot of them won't lend under 600. So if you're on the lower side of credit, it might take you talking to a few different lenders to find one that actually works for you. But beware, and if I may be a little frank, if you have bad credit, you're usually not going to get the best loan. You're not going to have a good selection of lenders, and sometimes they're going to charge you a higher interest rate or more closing costs to do your loan because you're what's considered a higher risk borrower. Well, that's not always the case, and it's still worth talking to other lenders to see what they can do. Sometimes it's better to take 3 or 6 months, pull a copy of your credit report, which I'll have links in the description down below that will allow you to do that for free, and try to get your score up to at least 580 or 600. That's going to give you the best opportunity to get the best loan for you, because obviously having a mortgage is going to be one of the more expensive things that you do in your life, and having a lower interest rate over the term of like 30 or 15 or 20 years is going to save you thousands of dollars. So it might be worth taking the 3 or 6 months, putting off your home buying experience, and then getting your score up so you can get that lower interest rate. Now, on a conventional mortgage, like I said earlier, one of the reasons why someone would go FHA rather than conventional is because of credit score. On a conventional mortgage, lenders are going to require at least a 620 credit score. That's the minimum, but that also means that you're going to have a much higher interest rate. So again, it still may be better to go FHA if you think you're on the lower side of credit. But you'll want your lender to do a cost analysis, because sometimes it might be better depending on how long you want to have the home. Sometimes it might be better to pay the higher interest rate on conventional because you'll have lower closing costs if you're going to live in the home for like 2, 3, 5 years, something like that. If it's a more long-term home, then it might be better to take the lower interest rate and pay a little bit more cost now with an FHA. Again, that's something that you're going to want to talk to your lender about. And guys, these are very common questions that lenders get, so don't be afraid to ask for a one-to-one comparison, conventional FHA, or ask them what the best plan for you is going to be. just again, depending on how long you're going to be in the home. Now, speaking of interest rates, let's go over that. Now, in this video, I'm not going to go too in depth about interest rates, and I'm not going to teach you how to read a rate sheet or anything like that. It's not super important, but I want to give you a few tips, tricks, or questions to ask or things to look out for when you're talking to your lender. So assuming you have pretty good credit, which would be, you know, let's say average credit of like 680, 650, somewhere around there or higher, an FHA loan shouldn't have that much higher or any higher interest rate than a conventional mortgage. But a lender can price a loan using what's called points, meaning that they can either charge you for having a lower interest rate or give you a credit for having a higher interest rate. This means that if one lender quotes you, let's say 3% interest rate, and another lender quotes you, let's say 3.5% interest rate, it doesn't always mean that the 3% is the better deal. The longer you stay in the home, the 3% will be the better deal, but you have to ask your lender if they're charging what's called points. 1 point equals 1% of the loan amount. So on a $200,000 mortgage, they could be charging you $2,000 to get the 3% interest rate, and this would be due at closing. So you want to ask your lender or make sure that your lender is not charging these points. If you're okay with paying that to have the lower interest rate, that's perfectly fine. You just want to make sure that's disclosed to you or that you understand that ahead of time. And if you're not okay with that, or if you don't have the money, then ask your lender what it would cost or what the interest rate would be with no points. If you do that between two different lenders, it lets you know that you're comparing apples to apples, because generally lenders are going to be within 0.125% of each other, sometimes 0.25% of each other. You just want to make sure that you're not going off of, hey, they quoted 3%, the other one quoted 3.5%, and I'm just going to go with the 3%. It could mean that you have a lot more money or that you're paying a lot more when the 3.5 would have been better. It's really the only way to make sure that you're getting the best deal. Comment down below if you have any questions about this, or if you want me to do a deeper dive or make a separate video just on shopping for mortgage rates. One of the big reasons why someone wouldn't get an FHA mortgage is what's called mortgage insurance. Now, again, I just talked about it a couple minutes ago. There's what's called upfront mortgage insurance, which is 1.75% of the loan amount. But then there's a monthly mortgage insurance, which is 1.35% of the loan amount. And so on our $200,000 home example, you'd be paying an additional $225 per month for the mortgage insurance. Now, you would have this on a conventional mortgage as well. The difference is that on a conventional mortgage, it can be a little bit cheaper per month, but also once you have 20% equity into the home, it goes away. Whereas on an FHA mortgage, it doesn't go away, or you'd have to refi to a conventional mortgage to make it go away. Whereas on a conventional mortgage, it just drops off once your home is either worth 20% more, or you've paid down your mortgage by 20%, or a combination of the two. Again, unless you have 20% down, you're going to pay mortgage insurance. It's just important to understand that, again, on conventional, it goes away and you don't really have to do anything. On an FHA, you would have to refi, and depending on the market, the rates could be much higher. So it's something that you want to look out for ahead of time, because $225 a month over the course of 30 years is a lot more money, and you wouldn't normally have to pay that if you go to conventional. Most people go FHA because of the lower credit requirements or the lower down payment. FHAs aren't bad loans. We do them all the time. They're just, you kind of have to go in with the expectation that once you get your credit higher, or once you get enough equity into the property, you would refinance it over to a conventional mortgage. Again, it kind of depends on how long you plan on being in the home. If it's going to be your first home, generally speaking, you're not going to stay in the home for more than 5 or 7 years. So you will pay a little bit extra each month. It really doesn't matter, and it shouldn't prevent you from buying a home. Again, FHA loans are perfectly fine. You just have to realize the cost associated with them in comparison to a different loan type. Now, to round out the video, I'll talk about what to expect with employment and income, some of the docs that you'll need. I'll talk about what's called debt to income ratio. This is going to give you a good idea on how much house you can afford, because the lender is probably going to calculate it a little bit differently than you normally would. And then I'll give you some of my tips that I would use to get your closing costs down. Because remember, on our $200,000 example, you could potentially need $19,000 at the closing table unless you use these. So let's get into employment. Generally speaking, the lender is going to have to verify that you have 2 years of stable work history. Now, that doesn't mean 2 years on the same job. That means 2-year work history total, and you can use school and military as part of that. They're just going to ask you to provide transcripts or military records. The only time this doesn't apply is if you're a business owner or a 1099 contractor. You're going to have 2 years straight on that same job or owning that same business, and you're going to have 2 years tax returns proving your income from that. And if you're a temporary employee, it doesn't instantly disqualify you from getting a mortgage, but it can be hard to prove that you have a stable work history, because a lot of times as a temporary employee, you're going to be switching temporary or temp companies, and you're going to be on multiple different assignments. So it's hard to prove that you have a stable work history. What lenders are looking for is that it's stable and that the income is likely to continue. So it's hard for us to verify that you have or that you've had a consistent work history or that your assignment is going to continue. While you may get new assignments, it's hard to provide information showing that, oh yeah, I'm going to continue to make X amount of money and I'm going to be able to repay the monthly payment. So income docs or docs that you're going to want to have handy. Again, I recommend talking to your lender at least 60 days in advance so that you know you can gather all this stuff so it doesn't slow down the mortgage process. So for a regular W-2 employment, you're going to want 2 years W-2s handy. You're going to want 2 months bank statements showing that you have the money to close in an account. And then you're going to want to have at least 1 or 2 pay stubs just to show your year-to-date income, showing that you're on pace to make your hourly rate or to make what you made last year. And then if you're a business owner, a 1099 contractor, or if you're retired, you're going to want to have 2 years federal income tax returns. And then you're going to want to have any 1099s, Social Security awards letters, or pension letters showing how much you make. And then again, 2 months bank statements. Now, the other piece for qualifying, and I'm kind of wondering why I lumped it in here, is debt to income ratio. Debt to income ratio is the amount of your income going towards debt each month. Lenders use this to determine how much home you can qualify. It's a pretty simple calculation, but lenders calculate it a little differently than what you or I would if we're looking to buy a home, and to make sure that we're buying the home that we can actually afford. And it looks like this. Let's say you make $10,000 a month and you have $5,000 of expenses, including the house that you're looking to buy. This includes like your debt that reports on your credit report, things like credit cards, car loans, mortgage payments, things like that. Not necessarily like electricity bills, medical insurance, nothing like that. It's usually things that are actually reporting on your credit report. But let's say you make 10 grand a month, you have $5,000 in expenses, you're going to have a debt to income ratio of 50%. Now, I don't necessarily endorse this, but one of the advantages of going FHA is you can have a debt to income ratio of 57%. Whereas on a conventional mortgage, you can only have a debt to income ratio of 45%. And so on an FHA loan, you could potentially buy 12% more house. I say I don't really endorse it because in reality, it means that you're buying way too much home and you're going to struggle paying for things like food, which I think is a little important, right? And then electricity and your utility bills, and you're not going to be able to save or have an emergency fund, other things that we're going to talk about more on this channel. Lenders go off pre-tax income. So it's the top of your line. It's not what you're actually taking home per month. So it's important that you do a budget before going to a lender and make sure that you can calculate a payment that you're comfortable with. Generally speaking, it's going to be about 35% of your take-home pay is going to be a good mortgage payment for you. If you can do under that, that's perfectly fine, but 35% maximum is the rule. If you go to your lender and say, pre-approve me for the maximum, they're gonna do on an FHA 57% of your pre-tax income. And on a conventional, they're gonna do 45% of your pre-tax income. Now, I don't know how to get away with without paying taxes, but generally speaking, if you do 55 or 57% of your pre-tax income, you're really more like 67 to 77% going towards your mortgage payment and debt. And that's just not a way to be financially stable. So I recommend just running your budget. Get a pay stub, look at what your net pay is, or get a couple pay stubs so you have a good monthly figure. Look at what your net pay is and just do 35% of that number. That's gonna give you a good idea of what you can afford for a mortgage payment. And if you have any questions, just comment down below or hit me up on Instagram and we can talk about it in a little bit more detail. And now finally, I'm gonna give you a few tips on how to reduce how much you need to bring into closing. So first, as I said earlier, you have to have 3.5% down. It can come from a gift, but you want to make sure that the money's not just sitting in cash in your home. It has to come from a verifiable source. So it has to be in your bank or in a 401k or a money market or somewhere that the bank can provide proof that you have it and where that money came from. And so tip number one is going to be to ask your realtor about asking the seller to pay for your closing costs. On an FHA loan, a seller can pay up to 6% of your closing costs. So on our $200,000 example, the seller could pay up to $12,000 of your closing costs. Again, the costs have to be paid at closing, either by you or the seller. They can't be rolled into the mortgage on a purchase. And so if you have the seller pay them or ask the seller to pay them, you could pay a little bit more for the home and still have it be worth buying if the sellers pay for the closing costs. Or in some markets, the sellers will just pay for it outright. It really just depends on how competitive the housing market in your area is. But it's something that you want to talk to your realtor about because it could potentially save you thousands of dollars. And sometimes the realtors, depending on your realtor, they might not like asking for it or they might not know to ask for it up front. Again, it just depends on the market, it depends on the situation. But ask your realtor, hey, I have this amount of money. Could we ask the sellers to pay for X amount? It doesn't have to be the whole 6%. It just depends on how much you need from your lender. But any amount of money given to you or any amount of money added to lessen your bill at closing is a plus in my book. Now, the other thing is that the 6% can also be used to buy down the interest rate. And so what that means is, let's say you have some of your closing costs paid for. You could also have the sellers pay to buy down to get you a lesser interest rate. Remember earlier in the video, we talked about points. The seller can pay some of those points to get you a lower interest rate. So again, it could potentially save you thousands over the life of the loan if the sellers are willing to do that. You just have to ask your realtor about it. Tip number two is to ask your lender about down payment assistance. As I said earlier, you have to have 3.5% into the mortgage. Here in Michigan, we have a program called a FHA loan. It's an FHA loan, but a third party called FHA will come in and they pay 2.5% of your 3.5%. And so you only have to come up with 1%. And so each state or each county can be a little bit different. But you want to make sure that you're talking to your lender about it because they might not know to ask or they might get busy and they might not think about asking you or talking to you about these options. So it's important that you bring it up. Generally speaking though, on FHA loans, if there's no programs like FHA, again, it's a Michigan only program. And there's other requirements there. But if you live in a different state that has very selective down payment assistance programs, they could still potentially be applied to your closing costs and your prepaids. And you'd still have to come up with a 3.5% down, but they could be applied to your closing costs. And again, that just reduces your ultimate bill that you need to bring to closing. A lot of times they're gonna be usually $10,000 and under, but hey, if it's a free $10,000, I'll take it. The other thing that you want to ask your lender is is the down payment assistance repayable? Meaning, so on the Mishta mortgage that I just talked about, you have to repay that money when you sell the home, or before you sell the home, or once you refinance. It's got to be paid upon closing on the next mortgage. So if you sell your home, part of the proceeds from the mortgage have to repay Mishta. Some programs have that, some don't. It's just something that you want to talk to your lender about and make sure that you know, hey, do I owe this money at the end, or is it free money? Because there are programs that just give you free money for getting a mortgage. Not all of them are the same though. So if a down payment assistance is available to you, you want to make sure that you can apply for it, or that it is applied, because again, it can be free money that you're getting to reduce the cost of your closing. And now the third tip, it's kind of the least desirable, but it might be a good option for you if the other options aren't available. Remember I said earlier in the video, a lender can charge you more money to have a higher, or to have a lower interest rate. Well, they can also give you a credit or pay you to have a higher interest rate. And so you could ask your lender, can they offset some of the closing costs by giving you a higher interest rate? The higher the loan amount, the more that might make sense, because let's say 0.125% of 100,000 is going to be less impactful than 0.125% of a million. And that's the credit that they could give you. Or it's a sliding scale, but they could factor in how much credit they could give you for a slightly higher interest rate to help offset some of those closing costs. Now, again, this isn't the most desirable way to do it, but it could help offset some of those closing costs and help you close on the home that you want if you don't have the money or can't come up with the money out of pocket. If you go this route, make sure you talk to your lender about how much it's going to cost extra per month, or how many months you need to have that mortgage, because the longer you have that mortgage and the longer you have that higher interest rate, the more interest you're going to pay. So it's going to be worth maybe putting on your calendar like 60 months from then to refinance and get a lower interest rate, because it'll at least help you get into the home that you chose, or help you at least close on the loan. Just keep in mind that when you get a mortgage, yes, you get a 30-year or a 15-year mortgage. Most people don't keep that mortgage for the 30 or 15 years. They end up refinancing, selling the home. There's multiple reasons why you would close out that mortgage, which is what a refinance is. You close out one mortgage and start a new mortgage. And so don't let these things deter you. Again, a slightly higher interest rate or something like that shouldn't make or break you buying the home, because there's always other options. And if you have a trustworthy lender, or a lender that you trust, they're going to be able to walk you through these as you go through your home buying lifespan. Again, it's not ideal, but it is another tool in your toolbox that'll help you close on the home of your dreams. All right, guys, I've had my say. Now it's time for you to have yours. Are you considering getting an FHA mortgage? Or is there any other mortgage related or personal finance specific related videos that you'd like to see, like rate shopping, house hunting, what to expect in a pre-qual? Comment down below and let me know what you're looking for, and I'll try to make a video on it. Otherwise, if you like what we're doing here, please hit like and subscribe, and we'll see you on the next one. Thanks, guys.